How do you build wealth in Nigeria in 2026? That's exactly what this video is going to cover. We're going to look at the investment landscape in Nigeria, stocks, bonds, real estate, alternative investments, and so much more. So whether you're a Nigerian in diaspora or you're a Nigerian living in Nigeria, you're a new investor or an experienced investor, you're going to get strategies on how you can actually build more wealth and grow your naira. We're also going to look at where capital is currently being allocated across these various investment vehicles in Nigeria, so you can be aware of the trends and follow the money. Our speaker is a senior investment analyst at Mainstreet Capital with years of experience managing billions of naira in investor funds. So this promises to be a very, very valuable session. So sit back, relax, and don't forget to subscribe.
My name is Onose Asotie-Enaholo. I am an investment research analyst at Mainstreet Capital. I'm the senior analyst. I lead fundamental research efforts. I manage the company's equities portfolio, and essentially, I'm in the market, day and night, 7 days a week. Well, I mean, even when the markets are closed on Saturdays and Sundays. Let's do this. So, like I said, first we'll talk about the investment basics, right? The wealth mindsets, active versus passive income, the differences between those, and compound interest. Then we'll go to wealth assets, asset classes for agents, risk, and then the Nigerian landscape, which is the more practical hands-on, where we go into the data and, I talk about the fund, the flows, and the frameworks. All right, so let's get in. Investment basics. What is the wealth mindset, right? The wealth mindset is very different from the rich's mindset. And a lot of people say, there's being rich and there's being wealthy. And it's easy to confuse both of them because both of them include you having money, right? It's like, if the bottom line is that I'm going to have money, who cares? But there is a difference. There's a difference that you need to be aware of, right? And the major difference is sustainability, right? I'm sure you've heard stories of people who they were up today and tomorrow they are down, right? They had a lot of money, this year, and next 5 years they're begging for money. They can barely pay their rent, right? So that's one of the different sustainability. Be wealthy if your money is sustainable, right? So according to Yahoo Finance, to be rich is to have cash that is above the median level in your region, right? According to the IMF, that number is about 1.25 million per year. 104k per month. And you'll be like, whoa, hold on. What do you mean? 104k is not a lot of money. But in Nigeria, it actually is. Only 2.4% of Nigerians earn more than 200k per month, according to statistics. So if you earn more than 200k, congratulations, you are in the top 2.4% of earners in this country. So it tells you that the general poverty level in your country determines how rich you are, right? So you're only rich if you earn above the median wealth in your region. So you might technically be rich by Nigerian terms, but still be struggling. And there are even studies in the US that show millennials are earning above $250,000 a year, which is the level for the global 1%. To be in the global 1% of earners, you have to earn about $250,000 a year. And so there are studies that are showing that even people that earn, at that level are still living paycheck to paycheck. They don't have savings, they don't have investments. So rich is a term. You have the lifestyle, but there's nothing in the bank if your salary stops coming in, right? All right. So wealth, on the other hand, centers more around assets than cash. I mean, I'm sure you guys are real estate professionals, so you know this, right? Now, these assets often generate income that takes care of your expenses, right? So wealth and riches differ with regions. The benchmark for being rich in a region may be different from the benchmark in other regions. And in most cases, it is, right? The benchmark for being rich in Nigeria is apparently 200K, 300K, 400K. The benchmark for being rich in the US is about over 100K, 120, 250,000, dollars per year, right? Which is over $10,000 per month. So you see very vastly different standards, when it comes to countries, right? Now you don't become wealthy when you buy assets, right? And this is a mistake that a lot of people make. And I've seen even a lot of real estate agents and real estate professionals make that mistake and say, if you buy real estate, you become wealthy. Real estate is always the key to building wealth. Just buy real estate. Yeah, I know that This is a real estate conference, but financial truths and financial facts are financial facts, right? And you don't become wealthy when you buy assets, right? You become wealthy when the assets start to produce income that is above what you need to live on. Now, personally, I have some real estate investments, but only a couple of them currently generate cash flow. The other ones, I'm just waiting for capital appreciation. In the meantime, that is not, you might say, okay, you're in the process of building wealth as it's appreciating, but only some of those assets generate enough cash flows for me to actually pay my bills. So if I'm counting, the assets that contribute to my wealth, I'm only going to, count the cash producing assets. Now, it doesn't mean if you have, land that is not cash producing, but is worth a lot, you're not wealthy. You are. But what I'm trying to pass across is, it's easy to get into that situation where you are just buying up land and there's nothing that's bringing anything to actually take care of your expenses. At that point, you are still building wealth, but you are not yet wealthy, right? Unless you can maybe sell the land if you are in a market where the land is very easily sellable, right? All right. Now, wealth also extends beyond money. It's about having time. Wealthy people use money to buy time. So if you want to know whether you're rich or wealthy, gauge which one you use to buy which. Do you use time to get money, or you use money to buy time? If you use time to buy money, then and you have a lot of money, then you're still rich. But if you're in a situation where you're not starting to use your money to buy back your time, to have that freedom, then you can begin to say, you're wealthy, right? So what is the key to building wealth? One, living below your means, right? A key part of building wealth is living below your means. Now, contrary to popular belief, not all rich people are wealthy, and I've already touched on that. In fact, a study in the US showed that 1/3 of millennials that earn $150,000 per year live paycheck to paycheck, right? You can be rich and still be in debt. In the US, they are in a lot of debt, right? And one prominent reason is lifestyle inflation, and it tends to happen to us, right? You are a real estate professional. You used to get 500K commissions. You upgraded your skills. You started selling bigger ticket items, bigger tickets, real estate properties, and all of a sudden you are getting 1.5. Your commission is now 1.5, and you're getting your commission at the same rate as you used to get it, right? And all of a sudden now it's before you were using an Android, and now you gotta use the iPhone, because that's you have to show people that your clients have to trust you, and your iPhone is what is going to help them trust you more. So it's that lifestyle inflation. You were living at Bagada before, now you have to be in Lekki, because Lekki is where the big boys are, so you need to network with them, so you have to get a house in phase 1, and so these are the things, and lifestyle inflation starts to creep, and after a while you start to ask yourself, but I am earning 3 times more than I used to earn before, but I even have less money than I have now. That's lifestyle inflation, and it comes slowly, and then of course you want to save face, because if your clients start seeing that you're in Lucky One, you're in Equities before, and now you're moving back to Magodo, what's going on, and that's how people get stuck, and they are bleeding money, and they to do. So you have to be careful with lifestyle inflation, right? It's a tendency to increase your standard of living every time your income increases, right? Now, so one way to gauge this is, has your salary increased, over the last 1 to 2 years? Good. Are you saving more? If not, then you might need to check your expenses, right? So now the wealthy may not earn as much as the rich, but they're able to save and invest because they manage their money and make prudent decisions, right? So some myths about wealth is that wealthy people live flashy lifestyles. I'm gonna tell you this now. Some of these guys that I see driving Corollas have more money than the guys that I see driving Benz. I'm not going to lie. That's one thing I realized, because it's not about how big the car you drive is, right? It's how big your investment portfolio is, right? A lot of wealthy people may not be as cash rich as the rich people, because they are always reinvesting, right? They don't I watched a podcast, the guy said he doesn't like seeing his money in his bank account just not doing anything. The money has to work for him. So mindsets like that. Another myth is that you can become wealthy very fast. Our crypto bros, our meme coin traders, our FX traders. Yeah, people think, okay, once you start doing FX, it's January, I'll be by April. Bent, right? That's not how wealth works. The process of building wealth is very boring and repetitive. Essentially, you will have to do the same thing over and over again for a long period of time. That's what it takes, right? There's a saying: money likes speed, right? Wealth likes time, right? So money has to be fast. Close deals fast. Do these things fast. Sell your products fast. Convert clients quickly. But for work, you have to be slow, right? Do the thing that works, that's been proven to work, and just keep doing that over a long period. That can be boring. Your nervous system might go haywire because, especially if you're used to, cutting deals fast to make money. By the time you now switch to being slow, it's like your nervous system wants the ginger. Where is the ginger? No, right? You got to be slow and building wealth. Right. Another myth is that you're wealthy if you have plenty money. Now, wealth is not just about money; it's also about peace of mind at times. Because what's the point of money? I don't know about you, but for me, money is not about flexing. Money is about peace of mind. I can be at a cafe, at my favorite cafe, at 2 p.m. on a Tuesday afternoon because I don't have to be at work. But I still work, so I have to be at work. But that's the goal, to get to a point where you're at the cafe chilling because your assets are giving you money. Not at least for me, everybody's definition is different. But for me, it's not fast cars, it's not Lamborghini. It's just hanging around who I want to hang out with, being where I want to be at any time I want to be, because I know that I have money coming in, right? Okay, so now let's look at the charts that I have here, right? So the rich, they often live in debt. They earn a lot of money. They're good at earning money. They're good at making money. They oftentimes live a flashy lifestyle. They do not save money. They spend a lot of money. They buy depreciating assets. Your 2025 Benz. Well, in Nigeria, cars tend to increase in price over time, but that's not supposed to be so. It's because of the economy we have. Cars are supposed to be depreciating assets. So you buy your GLE 450 this year. In 2 years' time, it's not going to be worth as much, ideally, right? That they spend a lot of money. They buy depreciated assets. Your iPhone 16. By the time iPhone 21 comes out, nobody cares about your iPhone 16 anymore. So depreciating assets, they spend to impress others, and they are not prepared for the long term. Meanwhile, the wealthy, they build long term. They buy appreciating assets. They typically take care of all their debts. They live well below their means. They live an understated lifestyle, which is very important. Like I said, the Corolla guys could have more money than the Benz guys, but you just won't know. They may earn less than the rich. They don't spend to impress others, and they save and invest a percentage of their income, right? So changing your mindset. The first step to building wealth is to change your mindsets, right? Is to change how you look at what it means to be wealthy, right? According to, I'm sure you have read about Rich Dad Poor Dad. It's a top financial book by Robert Kiyosaki. While I will advise that you should read the book, it's a good book. Be careful about who you listen to. Just be careful about who you listen to. Take the knowledge, but don't follow the person so much, right? Follow the knowledge itself. It says the rich have plenty of money, but the wealthy don't worry about money. So you can be rich and still be worrying about money, right? And you're generally thinking, how will I get another 50 million to do this and that? But the wealthy are like, this my farm is going to give me like 12 million this year. That's nice. That kind of thing. 50 million is more than 12 million, but the 12 million, you're chilling, right? You're chilling when you get it. But the 50 million you still got to always hustle before you get it, right? The rich work for money while the wealthy make money work for them. Now, as a real estate professional, you need to do both, right? While you are, chasing the high ticket items, you're trying to sell the 900 billion naira house, million naira house. Yeah, in fact, 900 million naira house, right? You're working for the money, you're going to get a commission, but when you get the money and you get the commission, what happens, right? Now, the key here is not just bigger commissions, but also passive income. Both of them work together, right? Now, one thing I see that is very popular on social media is, passive income. You just do passive income and you just set it up and you sit at home and that's all. It doesn't work like that. That's a myth. That doesn't exist, right? And we'll get into that later. But now the wealthy measure time, not money. If you stop working today, how long would you survive? right? We just survive to the end of the month. Today is the 23rd. If you stop working on the 23rd, we will see February 14th. We will see, will you be here with us, or you'll be gone? That kind of things, that kind of questions you have to ask yourself. Now, a practical way to do this is by calculating your wealth number, right? The amount of money you have in savings, that's liquid cash, not money that is tied down in your landing. The money you have in liquid cash, divided by your monthly expenses. That tells you how many months you have, right? And so and so if you do not have assets that bring cash in regularly, you will eventually run out of money. One thing I would advise people to do is gather a couple of your friends and play Monopoly, right? Play Monopoly. And you see that when you start Monopoly, the people that have a lot of cash are usually chilling, right? The people that are investing, buying up those plots of land and then building houses and eventually hotels, it's annoying at first because you don't have any money. If you get to jail or something, you have to pay, you don't have any money. But after a while, the longer the game goes on, and I've played this several times, the people who kept cash, eventually they always all run out of cash. And then the people who have their houses and hotels and everything, they're just chilling. So these are the things that you need to keep in mind. So now, so moving from the commission mindset to the wealthy mindset is, people in the commission mindset, they spend carelessly. And I say commission mindset because, as real estate professionals, I'm sure everyone is very familiar with commissions. So they spend carelessly, while the wealthy, they invest mindfully. Commission mindset, they are income driven, while the wealthy is mindset driven. I'm not saying you don't go for that income, but the income is a tool, right? The income is a stepping stone for something else. It doesn't end, your wealth journey doesn't end at the income, at the commissions, right? They're net worth driven. The commission mindset, they don't learn about money, they only learn about real estate, right? Does that ring a bell? Right? So they learn about money, while the wealthy mindset learns about money rather. Commission mindset, they only have a single flow of income, while the wealthy mindset have multiple flows of income. Commission mindset, they focus on problems. I don't have this. While the wealthy mindset focuses on solutions. Okay, how do I understand the investing landscape? And if you are here today, you're taking the first step to learning that. So congratulations, that's fantastic, right? The commission mindset, they only work for commissions, while the wealthy mindset, they make money work for them, while they might also be working on commissions, right? Commission mindset, they fear dry seasons. If I've noticed that maybe from January to March, people don't usually buy properties as much because maybe they are recovering from all the obole that they did over the holidays. You might think, how am I going to survive that period? But the wealthy mindset, they take action. So by maybe August, the period said they're thinking, okay, if I'm going to have a dry period, then I'm going to put this and this in place so that I have income coming in during that period, right? The commission mindset, they complain about money, while the wealthy, they find solutions to problems. And the commission mindset, they think small. The wealthy mindset, they think big, or they think longer term. The commission mindset, they don't have financial plans, while the wealthy mindset, they have financial plans, right? All right, so active versus passive income, right? What is this passive income thing that people like to talk about, right? So people think, okay, there are two categories. There's either active or there's either passive. It's not. It's a continuum. Think about it like a scale, right? So you have a scale or a thermometer, or like a weight scale. You're measuring your weight. Today you could be 65 kg. Tomorrow you could be 80 kg, right? Different people have different weights. So think about it like a continuum. And the different things and the different assets that generate cash, they are somewhere along the continuum. So they have a certain level of passivity or a certain level of activity, right, that you have to do. So there is no passive. I'm never going to have to do anything, or active, I'm going to have to do everything, right? So everything stays on one scale. So some investments are more passive than others, right? So it's a scale. For example, buying and trading stocks is a lot less passive than investing in like treasury bills, and we'll get into all of that later. But I want you to now, one of the key things I want you to take away today is, there is no singular category of passive income, right? So this is my passive income, this is my active income. If it's not here, it's here. No, it's a scale, and then have different levels of passivity, right? Now, passive income is often misunderstood. The popular belief is that it's income that you don't have to do anything to earn. Now, passive income is not binary. Like I said, it's more of a scale. Some types of income based on the sources are more passive than others. Now, real estate commissions are on the far left of active income, which means they are a lot more active. You have to put the work in, right? They require constant efforts from agents and professionals. Now, there is no income source or asset that is completely free from human oversight. That does not exist. It's only your treasures that are stored in heaven that are free from human oversight. Every other asset that exists on this earth needs a certain level of human oversight, right? You need to monitor it to some degree. It's just that the degree of monitoring that is required is what changes, right? Now, if all asset types require you to monitor them, I mean, it's best to go for the types that you understand. Now, before that, let me just before we move on, let me just explain the chart that I did here. For example, on one end, on the left end, you have the active income, and on the right end, you have passive income, right? And so you have a small business, right? Small business is very active, right? Active income, because expectation is that if it's a small business, you are running it yourself, right? As much as Bestate has staff that he pays, he still has to be active. He's still very active, right? Because he's running his business, right? Especially if it's an owner-operated business. So your level of activity is high, right? Rental properties as well, right? The level of activity is somewhat high. People who manage Airbnbs, you know what I'm talking about. Some Nigerians come in, and because they've paid caution fee, they throw caution to the wind. They give you their caution, so they are in your apartment cautionless, and they mess it up. So you have to be very active, in managing those properties. You can get a call at 1 a.m. The unit has run out, and you're like, come on, and then you have to sort that out. So it's active. It's pretty active. Freelance and consulting is also pretty active. If you don't work, you don't get paid. You don't eat, right? Now you have an index fund portfolio. Now, if I'm mentioning assets that I don't understand, don't worry, we'll get into all of that. An index fund portfolio is a bit more passive, right? You have to manage it, but not as much as a rental property, trust me, right? Or royalties. If you're getting royalties, you really don't have to do much, right? It's even more passive than an index fund portfolio, right? And fully automated digital products, some of them, depending on your level of automation, might be even more passive. You create a digital marketing course or a digital course or a real estate investment guide, and you upload it on Seller, right? And all you are doing is now funneling people to Seller to buy. Now, it's not completely passive. Like I said, that doesn't exist. You still have to funnel people to buy, but you're not always, you only did the work to create the guide once, and it keeps getting revenue for you, right? So there's a certain level of passivity. So just like I said, it's a degree, the degree of passivity that that is involved. So that's the myth about passive income that a lot of people don't understand. Everything requires human effort, right? It's just the level of human effort differs with the asset class. All right, so now let's talk about the power of compounding, which Einstein said was the eighth wonder of the modern world. Right, compounding is the process of reinvesting into your assets to increase its size, value, and the income it generates. It means not spending the money you get from your assets or commissions, use it to buy more assets. You buy a farm, your farm gives you proceeds. You carry your proceeds and you go to bow. I don't know, I'm into nightlife. You carry your proceeds and you go to bow home, and that's the problem, because you're eating your money. Yes, I mean, your farm can continue to give you money, but why not reinvest that so that the money you get from your farm the next season, it's a lot more. So that's compounding, right? For example, if you put 10,000 into a structured fund with Mainstreet Capital, that returns 10% per year. Each year you get 10,000. However, if after the first year you put the 10,000 back to and add it to the original 100,000, you have 110,000. At the end of the second year, you get 11,000, which is more than 10,000 the next year. If you keep doing that for 10 years, you have for 5 years rather, you'll have 161,000, as your primary or principal, which generates 16,100 per year, right? And so a lot of these structured products, you don't really have to do much, not because you don't have to do anything really, not because they in themselves are passive, but because you now have people that are managing them for you, when it comes to structured products, right? So yeah, that's the power of compound interest, and that works with everything: your knowledge, your skills, your relationships, your network. Compounding works across board in every facet of life, and the more you keep investing into things, the more they grow. Now let's quickly look at some wealth assets, right? This is 7 p.m. We have 1 hour to really dive into technical work. All right. What are some wealth assets? Now, I like to categorize assets into 3 categories, just so that depending on what you're trying to do, you know what assets really, really work for you. Income generation, capital appreciation, and wealth preservation. What is income generation? I want cash flows. I want cash flows every year, or every 6 months, or every 3 months, or every month. That's what I want. Specific cash flows coming in. That's what I want to see, right? That's income generation. There's capital appreciation. I want to buy my land today for 5 million, and in 10 years, I would like it to be 50 million. That's capital appreciation, right? And there's wealth preservation. I'm already a millionaire, right? I want to preserve my wealth. Inflation is eating it up, right? So I call Bestate. I'm like, Bestate, what do I do? Bestate says, oh, we have this house, this property in Banana, right? You can buy it. Will it appreciate? Yes. But more importantly, it will stop your wealth from being eaten by inflation. So the price of the house will continue to rise above inflation, right? And I'm sure if you're a real estate professional, you might understand what I mean, right? The price of the house will continue to rise with inflation. It's like, oh, okay, so I like to preserve my wealth. I'm gonna buy that house because of that, right? So depending on what you want to do, that really now determines the type of assets you invest in, right? So for income generation, some of the best assets are fixed income assets, fixed income, bonds, treasury bills, structured products, and also real estate, cash producing real estate, Airbnb apartments, long leases, regular rental properties, those kind of things, or dividend paying real estate investment trusts. It's kind of asset classes. For capital appreciation, you have stocks, right? Equities, cryptocurrencies with an asterisk. You gotta be careful. But cryptocurrencies, precious metals. I don't know if anybody's paying attention to what's happening with gold and silver. Silver is almost like $100. Gold is close to $5,000 per ounce, right? There's a lot of macroeconomics going on there, but you see that if you had bought gold this time last year, you'd be swimming in money. People are saying the women that buy gold in Lagos Island doesn't mean are rich now when you see them build them. But yes, capital appreciation, precious metals, and also land, right? You can buy a land today. We all heard the stories, your auntie that bought land in Sangotedo for 5 naira in 1864 now is 3 billion. That kind of thing. We know these stories. So that's capital appreciation, right? And then there's wealth preservation, treasury bills, certificates of deposits. Now, don't worry if you don't know what these are. We'll get to them. Treasury bills, certificates of deposits, structured products, and also real estate. So you have some asset classes that can serve more than one function, right? Treasury bills can serve the function of wealth preservation and income generation, right? Land and even real estate can serve, they can serve all 3, right? So that's good. So asset classes should not be chosen at random. That's the point of this. I hear that prices in the equities, the stock market is going up. I hear a lot of people are asking me about stock markets these days because they're like, okay, I want to say, yeah, come and tell us what stock should I buy? What stock should I buy? I hear stocks are going up. First, I tell them, calm down. Why do you want to buy stocks? What do you want to invest in? What are you trying to achieve? Right? So you ask yourself, what are you trying to achieve? You see, I'm just like, I want to make money now. I know. But, how? Right? Do you want regular cash flows? Do you want capital appreciation? Do you want wealth preservation? Because even the amount of risk and the risk appetite you should have is different with all of them. Income generation, you don't really have such a high risk appetite, right? Like medium risk appetite. Yeah, you're willing to take risk, but I need to see that cash flow, right? For capital appreciation, those guys usually have the highest risk appetite. They're like, oh, that's why if you notice, I only put crypto in capital appreciation, right? Stocks and crypto, capital appreciation. Precious metals, only capital appreciation, because it's risky, right? So if you know you want capital appreciation, you know that this is the risk level that comes with it. This is what your risk appetite needs to be, right? And so you understand what you're going into, not that you want to invest for your 50-year-old mom or your 60, 70-year-old dad and you're saying cryptocurrency and stocks. Like, please don't, right? They need either income generation or wealth preservation because their risk tolerance is not high because of how old they already are. But if you are young and your 20s, life is good, you have your life ahead of you, you can take on a little more risk. Actually, you can take on a lot more risk. I'm not saying you should, I'm saying you can. Right? And you can go for capital appreciation, and then look at those asset classes that are more likely to give you the best capital appreciation. So asset classes should not be chosen at random. There's a method to it, right? Your investment goals always come first, and asset classes are built, the assets you choose are built around those goals. Now, as a real estate professional, what are your investment goals? Write them down, right? You know what? I'll give you 5 seconds. I know most of you need to write, but write them down. Even after the class, write them down where your goals are, right? Write them down in the context of these categories that I have just I'm giving you, either income generation, capital appreciation, or wealth preservation. Write them down. All goals fall into one or more. So you either have maybe like two of these reasons to get assets, to the left. So that's one thing in it. So when you now know that, okay, what is my risk tolerance? Because you can't say, I'm risk averse, but I'm looking for capital appreciation. Yes, it could work, but it's not the best, right? If you're risk averse, go for income generation, go for wealth preservation. If you're risk averse and you have plenty of money, go for wealth preservation. If you're risk averse and you don't have plenty of money, income generation. That's all. If you are ready to take on risk and go for capital appreciation or even also income generation, you can split between both. Maybe do 60% capital appreciation, 40% income generation, so that as you are building your wealth, you can eat so that you can live long enough to see your wealth appreciate. That kind of thing. So you know what you are doing. You're making informed decisions based on who you are using these frameworks. So this is the second thing I really want you guys to take away today. Income generation, capital appreciation, wealth preservation, and the assets you choose. Don't choose asset classes that are random. Right, they should fall under one of these categories, and this category should ideally match with your risk tolerance. Right, so pick these categories based on your goals, your time horizon, and your risk tolerance. All right, let's move on. So the 2 cardinal rules, right? So now I made this specifically for real estate agents, right? Because real estate professionals, I'm sorry, because you guys are you're in the space, right? So you may or may not have more access to some of these deals than, the regular folk. Now, income generation for, specifically tailored to the real estate professional is, your fixed income securities, bonds, T-bills, buy-to-let residential units, right? Commercial real estate, structured products, at firms like Mainstreet Capital, and short-let apartments, right? Your capital appreciation are real estate investment trusts. You can buy some of those on the Nigerian Stock Exchange. Land, of course, and JV deals with landowners. Those some of you that might be developers, you know what I mean, right? JV deals, right? We do JV deals here all the time, but our JV deals are in the millions, hundreds of millions that we do here, But yeah, if you have a JV, you need funding, you have all your papers right, reach out, we'll fund you. Of course, we'll assess the situation and we'll fund you. We just funded someone it's like the tune of like $500 million. So you can do the JV deals, and if you structure them well and you execute them well, you can get a lot of money. You can make a lot of money, right? And so that's capital appreciation, right? But it takes a lot of risk. JVs are no joke, right? And now that's what's going on in what's this estate in Aja, Palm Beach estate, right? If you don't have your papers right, all your money can go down the drain. So there's risk, right? And then wealth preservation is treasury bills, certificates of deposit, structured products, and real estate in already established areas. So Lekki Palm City, thank you, right? So real estate in already established areas. So real estate in Banana that you know that the government will not come and start breaking it down because everything has been set, everything is soft, as they say. So the two cardinal rules of investing: number one, do not invest more than you are willing to lose, and do not invest in things you do not understand. That is one thing. Do not invest in things you don't understand. There are some asset classes that I will never touch. I do not touch options, right? As people doing, oh, let's trade options. I'm good. I'm gonna stick to what I know, right? So don't invest in things you don't understand. So hopefully, I'm here today to hopefully, expose you to more things so you begin to understand more things so that your investment horizon, expands a bit more, right? All right. So this is the end of my first slideshow. This is theory, right? Now we're going to go into the practical. Is this the, yes, stop presenting. We're going to go into the practical, right? We're going to talk about Nigeria. And what's going on in Nigeria, and what are we going to expect? Now, I made sure I tried to make the first set of slides very nice, very appealing to the eyes, very visually stimulating. This one is not going to be visually stimulating because we're going to be talking about it, or what I'm going to be talking about it. So this is more on you listening to the frameworks. If you do not have a pen and a paper, I would advise you get one. Like I said, I'm going to be diving deep into this, right? And we're going to go quickly, right? Because I don't want to keep you guys here longer than 8 p.m. I don't want to keep myself here as well longer than 8 p.m. So I'm going to be talking about a lot of things that are going to be happening. I'm going to be mentioning numbers. Don't worry, I'll try not to overwhelm you. What I need you to look out for are the things that are going to happen, right? The structures, the frameworks in which, I'm looking at this market, right? That's what I really want you to get, the benchmarks. Like the analogy I gave with the billboards, like if you see this billboard, it means you're getting close. Those are the things I really want you to pay attention to, right? So let's get into it. The wealth map, navigating the Nigerian investment ecosystem, 7 asset classes, 6 structural narratives, 1 framework. One thing to note. Now, before I start, this is not financial advice. And though, let me indemnify myself. Now, don't get me wrong. Everything I'm going to tell you is research backed. Some of these strategies are what I'm going to use at my firm this year, right? Some of these strategies are what I used last year, at my firm. So what I'm telling you is, is backed by facts. But I still have to give my disclaimer. It's not financial advice. It's knowledge that I'm trying to pass through, right? So I think I should first talk about my investment style and the framework which I used to talk about the markets. I don't look at the markets randomly, right? If I were to talk about my investment style, it would what I would use to describe it would be macro assisted short to mid-term growth investing. So now what is macros? Macros is macroeconomics. I look at macroeconomic and political trends, macroeconomic trends and political policies, right? I look at what policies are bound to be more prominent or the most prominent, within the period, which for this time is 2026. I look at what the macroeconomic trends are going to be for 20, right? So I look at what the macroeconomic trends are going, what macroeconomic trends are going to be the most prominent, in any given year in 2026, right? Then I look at political and government policies, right? What are the government policies? What are going to be the most prominent policies? Then I look at the sectors of the economy that these trends and policies will most are going to affect most positively, right? Then when I look at that, I look at the companies that are within those sectors that will benefit most from these. So like a top-down analysis, and that is what I do, right? And so when I say growth investing, yes, the opposite of growth investing is value investing, where you look at companies that are underpriced or undervalued. I'm not so much looking at companies that are undervalued. I'm looking at companies that have the highest growth potential in 2026. That's my strategy. That's how I look at the market. And so far, it has worked for me. I have more than doubled my company's equities portfolio since I started managing it in 2023. Someone is saying the line is breaking. Is that on everybody's end or just one person's end, so that I know? All right, so that is what I do. So we're going to talk about 7 asset classes today. And so I take all this knowledge and I build out what you call narratives, right? And I look at now the companies that benefit most, or the sectors that benefit most from these narratives. And all of these narratives are under one framework. So that's why I said 7 asset classes, 6 structural narratives, 1 framework, right? This is my investment outlook, and this is my capital flow analysis. Let's get into it. No. All right. Now, the Nigerian investment landscape, the 2025 foundation. Now, we need to start from somewhere, right? The NGX market cap closed 2025. So the NGX is the Nigerian Stock Exchange, right? It's the stock market in Nigeria here. It closed 2025 at 99.38 trillion, which is the highest it's ever been, higher than 62.7 trillion in 2024, right? Right, as of close of market today, it is 105.95 trillion. So you have a lot of money coming in. A lot of retail traders are coming in. A lot of institutional traders are coming in. Close to the end of last year, a lot of PFA, pension fund administrators, they started to increase their allocations to the equities markets. Pension fund administrators, or PFAs, are the companies that manage your pensions. Well, if you were, I don't know how pensions work for real estate professionals, but if you are in a regular 9 to 5, then your company pays, a part of your salary as pension, and it matches it. So every month, some money goes into the pension. So you have some major pension fund administrators like Stanbic, and these guys, they manage trillions. They have a lot of money. So if they are increasing their allocations to equities market, then you see a lot more inflows coming into the market, right? So for the fixed income market, close at around 51.48 trillion. That's bonds, commercial papers, which is what CPs are, and T-bills combined, right? Now, the macroeconomic setup. What are we looking at, this year? The IMF, the International Monetary Fund, have projected that will grow at about 4.4%. The Nigerian economy will grow at around 4.4% in 2026. They also projected that in 2025, we grew at 4.2%. Now, because our official Q4 GDP report is not out, we don't know exactly when, what our GDP growth is for the entire year. But it's close to that. It was about 3 something, around the high 3s at the last time. In Q3, in Q2, it was about 4 something. So it looks like it's going to be close to 4.2, right? 4.2%. So essentially, the takeaway from this is this: our GDP is expected to grow at a faster rate this year than it did last year. And that has ramifications for a lot of things, right? A lot of industries, right? Expectation, inflation is expected to ease to 12.94%. It's currently at 15.15%, lower than 17.33 in November. So December was 15.15, which was lower than 17.33. So we're seeing inflation start to really come down, which is good, driven largely by, disinflation in the food production. So we're seeing, more bountiful harvest, which is, pushing down the prices of food. Last year, the government also made a lot of efforts to secure the food value chain. So all the processes that happen from food to get from your farm to your table or to your local market, the government stepped in to help with logistics and security in some ways. And so you have a lot more food output coming out from the farms now. So you have inflation really falling, right? And now you're looking at monetary conditions, right? The CBN is holding their interest rate to 27%. Right, they slash interest rate from 27.5 to 27%. Right now, if you don't understand what I'm saying, don't worry. When I read through it, I'll explain it. And now the external position, which is our foreign reserves, is at $51 billion, and there's a current account surplus of $18.8 billion. What does this mean? All of these underpin a macroeconomic. Remember, I said it's macro. So I look at macros first before I now start going into the sectors and everything, right? And the asset classes, right? So it's like, I want to know, how is Nigeria doing as a country? So if you look at the macroeconomy, you want to look at GDP growth rates, right? It's easier for asset classes to go up in value if the entire economy is growing. So that's the first thing to keep in mind, right? Second thing is, monetary conditions, right? Money is the lifeblood of every economy, right? If money is cheap, then there's a lot more money in circulation. What does it mean for money to be cheap, right? It means if the rate that you borrow money at is cheap, then that is a good thing, because it means businesses can borrow more money and expand. So imagine a Dangote Cement can now borrow money cheaper, build more cement making equipment, and then output more cement and sell more cement and make more money, and then you see Dangote Cement stock that starts to go up. Things like this affect these companies, right? And then external position, the FX, our foreign reserves. For those who do not know, there is a very strong correlation between our foreign reserves and the strength of our naira against the dollar, right? And this is something I noticed last year, right? Every time our oil production rate goes above 1.6 million barrels per day, the amount of oil we produce in Nigeria, our FX, our foreign reserve, it starts to rise, because the government is selling oil and getting more money from oil. So it starts to rise. And if there's a lot more money in our foreign reserve, then the CBN can come in and defend the naira. So it means with more money in our foreign reserves, the government can keep your exchange rate below 1,500 naira per dollar. So that's the first thing, right? If that happens and the government can keep FX rates within a certain limit, then you have a situation where foreign investors see that and are like, okay, so if I change my dollars to naira to buy Nigerian equities, if I sell it and I want to convert that naira back to dollar to take back to my country, then I know that it's not going to be more than 1,500. I can plan around that. And so you now see a lot more money coming into the equities market, and you see stock prices going up. So you see how underlying macroeconomic conditions affect the prices of the assets that you want to buy, right? If you have foreign investors looking, it seems like their FX rate is stable, I can now come in and buy real estate. Then you have more real estate demand, right? Prices of real estate go up, you get more commission. So these are things you need to look at. You need to lay the foundation, right? So please, if you are taking notes, write this down, right? You're looking at GDP, you're looking at inflation, you're looking at your monetary conditions. What is interest rate? Is at 27% right now, right? And your external position or your foreign reserves, right? So let's quickly run through. Now, 6 structural narratives anchoring 2026 flows. I want to really get into it. Now, I told you I've looked at macroeconomics, right? I look at sectors, I look at what's going on, I look at government policy. Now, I've done all that research on the back end already. And these are the 6 I think most potent narratives that I think will drive, activities in the equities market. Now, some of that will spill over to fixed income, and we'll get to that. But these are the ones that will really drive in the equities market. 1, oil production momentum, right? Last year we started to hit record levels of oil production, right? We want to see more of that happening, in the markets. Now, if that happens, what are the implications? 1, all producers, right? Companies that produce oil. What are some of the companies that produce oil? Aradel, Seplat, Oando, right? Those are some oil producing companies, right? If the country is producing more oil in general, it means this companies, because the amount of oil they produce is counted along with the total amount of oil produced in the country. So if you are seeing significantly higher oil production numbers in Nigeria, then it means these other companies are producing a lot more oil. If they're producing a lot more oil and they're selling a lot more oil, it means their revenue, given certain conditions, their revenue can grow. If their revenue grows, it means their profit too can grow, right? And then this happens, and then you see their stock prices go up. So that's one thing that, to look out for, oil production momentum, right? If there's more oil production, then possibly they could deliver more oil to refineries like Dangote Refinery, and he could produce more, buy cheaper, import less oil from the US, buy cheaper oil here in Nigeria, and then fuel prices are cheaper, transport costs are cheaper. So those are things that you need to watch out for. Number 2, local pharmaceutical scaling. $2 billion have already been invested in setting up capacity and plants for local pharmacies. In 2023, a lot of foreign pharmaceutical companies left Nigeria, like GSK, GlaxoSmithKline. They left Nigeria, right? So now local pharmaceutical companies are beginning to pick up the slack, right? And so if that happens, and on the government end, you have a situation where there's a new tax policy, and in the tax policy, pharmaceutical companies are exempted, from some type of taxes, right? So you can have even higher margins for pharmaceutical companies. So it means that they could have higher margins. You can see higher earnings. If that starts to happen, you see stock prices for pharmaceutical companies start to go up. You could possibly see prices of some of these drugs start to come down, right? But now these narratives I'm looking at are primarily in the equities market, right? So now you have Islamic banking, right? Now you may not know this unless you're in the finance space, which I am, but there is a lot more interest in Islamic banking products. Sukuk, Mudaraba, and a couple of them. Now on the Nigerian Stock Exchange, there's only one listed Islamic bank, and that's Jaiz Bank, right? So now you have to be careful because Jaiz Bank is already up like 7 to 8 naira from around 4 naira at the beginning of the year, right? So, but there's only one. So if anyone that wants to get exposure to the upside from the new interest in Islamic banking, there's literally only, unless you're investing in the products themselves like Sukuk bonds and all, there's only one company to invest in the NGX, which is Jaiz Bank. So that's something that's worth watching, right? It has first mover advantage. Now there's insurance recapitalization, right? There was a law, a circular passed by regulators that all insurance companies must raise their capital base to 15 billion, right? And one thing I really like about insurance is it cuts through other narratives. For example, the oil production. If companies like Ardell and Seplat are increasing their oil production, it means they will increase their insurance because they pay for insurance for these things, right? So if insurance companies that insure energy companies, the energy companies are expanding and are buying more insurance, it means more insurance premiums for these insurance guys, right? So that's possibly higher insurance earnings. Right? So that's one thing to look out for, even for that. Same thing with even in industries, right? Are there insurance companies that these local pharmaceuticals are trying to scale up, right? And build new factories? Are they not going to buy insurance for it? They will buy insurance. So who are the insurance companies that are going to insure these companies coming up? That's it. That's a new source of revenue for insurance. And then you see insurance revenue going up and you see insurance companies doing well. So that's another thing that's going to happen, right? Industrial policy focus. There is the Nigerian industrial policy, right now that was signed into law late last year, I think. Basically, they are going to start preferring local production, local substitution to foreign imports, right? So what companies are going to benefit from that? One, local pharmaceutical companies, right? Local agro-allied companies, right? A new company called Zikis Agro-Allied just listed on the NGX. Now, these companies that I'm mentioning, I'm not saying invest in them. I'm not giving you what to invest in. I'm just giving examples, right? You have NASCON, you have Union Diconsult, you have a lot of these companies that are coming up that are into local production. And if you now have government policies that are going to support them, then of course, they could potentially do really well this year. And then you have support industries, which is oil services, air, marine. If I'm an oil company, I want to ship my oil across the waters and everything, I'm going to use some of these support vehicles. I'm going to use some of these marine support vehicles, aren't I? I am going to do that. So if I am a Dangote refinery that is going to start delivering oil locally, Dangote is not going to carry the jerrycans and walk to your house himself. Trucks will do that. So who owns the trucks, right? Are they companies that provide the trucks? Are they companies that make the spare parts for these trucks, right? Who insures the trucks? Which insurance company insures those trucks, right? So these are the things you do, that the narratives I'm looking at for this company. So 2026 is going to be a really great year for stocks, right? And so I'm looking at these narratives. So if you want to take a screenshot of this page, take a screenshot of this page, right? All production, local pharmaceutical scaling, Islamic banking, insurance recapitalization, industrial policy focus. That's, small to mid cap producers, and support industries. These are these things I'm looking at. These are the narratives. Those are the 6 narratives that I have, right? So now let's talk about asset classes in a practical sense, what we should expect from each asset class. All right, so the first one is equities. So as of 2025, we had a 99.38 trillion market cap and a 51.19% year-on-year return. Banking recapitalization, and the NGX ASI hits 155,000 points. Now, like I said, looking at equities from the framework, using the framework I just gave, the narratives I just gave, right? You're looking at oil and gas, RDL holdings and Seplat, to ride all production momentum, and marine logistics, pharma and healthcare, May and Baker, Fidsin for local production, right? Financial services, Islamic banking and all, recapitalization, industrials. So when I say flour mills, I don't mean the company flour mills. The flour mills doesn't even trade on the exchange anymore. But like milling companies, maybe honey flour and all, cement making companies, chemical production companies, I think Unicell as well, basically companies that you could use to replace, that could be local replacements to imports, right? That's what you're looking at, right? And then consumer goods, end products, beer, soft drinks, So these are what you're looking at for, these are the frameworks, these are, the narratives that I'm looking into, for equities this year, right? Now, what are the policies that are going to, that are going to really support this? All the regulation, local manufacturing incentives, like I've talked about, banking consolidation, which is bank recapitalization, it's already completed, and the CBN liquidity rules favor equity demand. Now, when should you allocate, right? Growth-seeking portfolios with a 3-year horizon. For mid-cap industries like pharma, schools, and everything, you could have an asymmetric, risk to reward. And asymmetric just necessarily means that the amount of reward far outweighs the risk, right? But it might take a while for them to build these companies, build these factories, and start production. So you're looking at a 3-year horizon for that. It doesn't mean the stock prices won't do well now, but you should also have like a growth, a capital appreciation mindset, in that regard. Now, portfolio fits 20 to 40% of your growth portfolio if you're into capital appreciation, 10 to 20% if you're more balanced, looking for income generation. Now, when should you enter? And that's the main question. When should I buy these stocks? Right? When you see all production spikes. So now you're gonna have to read GDP reports for this, or you have ChatGPT. You can just ask ChatGPT, has there been any oil production spikes in Nigeria? And it will tell you, right? If you see significant increase in oil production, RDL is with their some acquisitions that happened last year, they're able to increase oil production from 15,300 barrels per day to 90,000 barrels per day. So if they start producing at 90,000 barrels per day, you will see that reflected in the total amount of oil that's being produced in the country. So look for things like that. So that's the first billboard for all companies. Is there a spike, an increased spike in oil production? If you see that, then it means that good. These companies are producing more. And then you can start looking to get into them. For pharmaceutical companies, it could be announcement of new factories. That's when you can look at news for if they're announcing new factories. You hear, May and Baker I just said, we're launching this new factory. Aha, that's what you're looking for, right? And for that, so the 2024-26 flow thesis. Now we expect at least a 15 to 30% total return from the equities market this year, right? Which is price appreciation plus dividends. Now you have that for the oil narrative. The pharmaceutical narrative, local capital expenditure, flows to producer scaling, Islamic finance, non-interest banking is growing, right? Non-interest banking is growing, and you see that happens to Cook insurances and everything. And then for insurance, the recapitalization deadline is in July this year. So you might see some mergers and all, and the best capitalized insurance can now provide insurance to aviation, to marine, to energy, and get more profits from that. And then mid-cap manufacturing, industrial policy tailwinds, no FX volatility, then being substitutions for imports. So I'm really looking at agricultural processing plants, people that maybe produce one of the inputs that pharmaceutical companies will use, right? So if maybe to make a certain drug, a pharmaceutical company needs a particular product, and it's another company that manufactures that product. Okay, so who manufactures that? And let's do that, and then also textile companies. So you get that kind of thing, and that's expected to, grow at a compounded rate of 20 to 25% this year. So that's something that's happening. Second asset class, federal government bonds, right? Now, the average yield right now is about 16.73%, which is significantly lower than last year, right? The 10 years around 16.87. And now, but what's happening right now is this: the government is doubling the amount of money they're going to borrow. So in the first quarter of this year, not even first quarter, in January, they want to borrow 900 billion. For them to be able to borrow 900 billion, they have to increase rates, right? So if you want to lock in the best rates in fixed income, now is the time. There was a Treasury bill auction yesterday, and the 1 year rates are already up to 18% from 60% in December or November last year. So if you want to lock in these rates, now's the time, right? Because the government does most of their borrowing in the first quarter of the year. So the best rates in the fixed income space are usually in the first quarter of the year, and then anything else is just the government just kind of maintains, right? And that's because of the budget deficit, which is around 20 trillion. So the government will want to borrow a good chunk of that 20 trillion in the first quarter, right? And so they will increase interest rates they will increase not interest rates, they will increase the auction rates, right? To do that. So some people don't understand treasury bills. All right. So it's like this: everybody borrows. If you need money, you go to Fair Money to borrow. When you want to borrow, they'll tell you, look, this is our percentage. We'll charge you 3% per month, right? And then you borrow the money, and then you have to pay Fair Money, their interest and their principal. Those are what treasury bills are. So the difference between treasury bills and bonds is that treasury bills are for a tenure of 1 year. So you can't hold a specific treasury bill for more than 1 year. After 1 year, they expire. While for bonds, you have 10-year bonds, you have 20-year bonds, you have 30-year bonds. I can buy a 30-year bond today and hold it for the next 30 years and be getting interest every year for the next 30 years, right? But for treasury bill, it's never more than 1 year, right? So that's essentially the difference, right? So if you want to profit from fixed income, but you don't want to hold a 10-year bond. Why would I want to hold a 10-year bond, please? I'd rather just hold something this year. Then treasury bills are for you, right? So now treasury bills, there is no default rate. There's no default risk, rather, because it's risk-free, because it's backed by the government, right? And the government will always pay back, right? So at least right now with the Nigerian government, treasury bills are risk-free, right? So those are what T-bills are. So the government wants to borrow, you buy treasury bills, you borrow the government your money, and then at the end of the tenure, they give you back the money. So treasury bills, they don't pay you yearly interest like they do with bonds, right? It's called a discount rate. So what they will do is they will discount the price of the bill. So if they want to issue a 1 million naira bill, right, and let's say the interest is 10%, instead of saying, okay, give us 1 million naira and we'll give you 10%, they'll tell us, no, give us 1 million naira minus 10%. 10% is 100K. So you will buy the bill for 900K. And when the tenure is up, they will give you back 1 million. You get? So with treasury bills, you lock in your rates immediately you buy. But you just don't get it until the tenure, until the end of the tenure, and then you get the money. That's when you realize the rate, but you lock it in immediately you buy, right? So that's between T-bills and bonds, right? So we're looking at so for the 5-year bond, it's around 18.5%. 7-year, then 10-year. So these are the rates that it's ended 2025 on, right? I think the first bond auction is going to be next week. Actually, it should be next week, right? So we're going to see what rates the government is willing to give out for these bonds, right? And so, like I said, you need to be paying attention right now, because now is the time you want to lock in these rates, these high rates, right? And if your clients are asking, You can also tell them that, right? So now liquidity in the secondary market is solid. So you can come to firms like Mainstreet Capital, and we'll just help you buy the bonds and even give you some advice on what to do. But yeah, there's a lot of liquidity in the market right now, and rates are expected to be the highest in this first quarter of the year. So that's what's going on. That's where funds are flowing. You see a lot of funds are going to come to flow. How much funds? Over 1 trillion naira. It was over 1.13 trillion. That was, people bid, the amount of bids at the T-bill auction on Wednesday was more than 1.13 trillion. So a lot of people are coming in. They want these bonds. A lot of them are foreign investors as well, but people want to lock in these rates. So if you're into income generation, you might want to lock in some of these rates, right? So I'm going to go through the next really quickly so that we have a quick, maybe a 10-minute question and answer session before 8. So by 7:50, we'll have a 10-minute question and answer session so that you guys can just ask any questions you want. All right. So for so when should you allocate, right? Income focused, low risk portfolios. So now, remember I talked about interest rates, right? So the government slashed interest rate from 27.5% to 27%, which is the cost of borrowing money, right? So bonds respond to interest rates. Lower interest rates usually means lower bond yields, the lower amount you get for yields. That's just how it is. So if there's an expectation for an interest rate cut in H2, remember, why did the government raise rates in the first place? Because of high inflation. Inflation has started coming down. So it now starts to think that, okay, if inflation is coming down, then the government will start to slash rates. So there's an expectation. They already slashed rates at the last Monetary Policy Committee meeting. The next one is in February, right? So it's like if they start slashing rates, then you expect that the yield you get from bonds and T-bills will be lower. So that's why I said it's better to lock in when it's high than for them to wait to slash rates and then you're locking in lower rates, right? So that's the thing. So the expectation is that by H2, if in the first half of the year they don't slash rates, there's an expectation that they will in the second quarter, the second half of the year, right? So if you're conservative, 30 to 50% of your portfolio should be this, right? If you're balanced, maybe 20 to 30%, right? Yeah. All right, so let's quickly go that capital flow thesis, the macro, the macros, the backdrop of the macro that supports this is, inflation pushing down, right? Domestic demand, there's more demand for, Nigerian investment assets right now, thanks to all the, the stable FX liquidity and things like that. All right, so the third one is commercial paper, right? And the money markets. Commercial paper is essentially when a company wants to borrow money. So if it wants to borrow money for a period less than a year, it issues a document called a commercial paper. If it's more than a year, it's called a corporate bond. It's basically like a government bond, but it's a corporate, that's a company that issues it and not the government, right? So a CP is the corporate version of a treasury bill, right? Essentially. So CPUs are around 22 to 26%. Now CPUs are more affected by interest rates. So if you have interest rates coming down, CPUs will come down even more significantly than government bonds. Now if you are looking at CPs, please, blue chip companies, Dangote Cement, possibly Fidelity Bank. I know they have a corporate bond. They pay off their bonds well. Wema Bank as well. They pay off their bonds well. Most other companies I can't really vouch for. These are like the three companies that I can vouch for. That Dangote Sugar, anything Dangote, he pays off well. Fidelity Bank for their corporate bond, Wema Bank as well. So these are the ones that I know. Now of course liquidity in that market isn't so great. So that if you're buying a bond, a corporate, a commercial paper for 6 months, you're gonna have to hold it for 6 months. If you're buying a T-bill, you can sell it off if maybe you have something urgent. But if you're buying a CP, most of the time you have to hold it for 6 months. So I wouldn't suggest holding a CP for longer than 6 months, really. But yeah, that's one thing you could do. Now CP policies, if you're trying to save and you're not going to touch your savings, of course you can buy a CP and get like a 20% for your savings for 6 months. That makes sense, right? 5 to 15% of your fixed income portfolio. And so that's good. All right, I'm just going to skip the CP flow thesis and look at treasury bills. Now we've already talked about bonds and treasury bills, so you know what's going on with treasury bills, right? So because of time, I'm going to skip this as well. Now real estate. I wanted to remove this because I'm talking to real estate professionals, but I am talking to real estate professionals, so I will bring this in, right? Now residential and commercial properties in Lagos, Abuja, Port Harcourt are expected to get a 5 to 15% appreciation. Now, if you are in the industry and you feel it might be more, it might be less, that's calm. But according to my research, 5 to 15%, right? Mortgage penetration is expanding. We don't really use mortgages in Nigeria, but that is slowly changing, little by little, little by little. Now, some of the segments that, I'm really looking at for are core commercial, real estates, retail, shops and offices. If you go on Admiralty, you see they're always building shops and offices, mostly shops, but also offices. Residential, mid to high income. Unfortunately, low income residential properties, I'm not really sure about the viability of them. Those seem more like government projects that you could not just use to, government projects to alleviate the housing crisis. But with the way things are in this country, unfortunately, it's mid to high income earners that can really, afford these properties. So that's our property market. So for the person who said they wanted to get a screenshot, don't worry. When we're doing the question and answer session, I can just go back when people are asking questions so that we don't derail anyone. All right, so now infrastructure spending. Now we expect there to be a bit more infrastructure spending on roads, rail, ports, right? A lot of you that sell land in Ekpe and Ibejleki, people like to say, oh, this port is coming up, this airport is coming up. So there are a lot of infrastructure spending going on, right? And these now increase the value of real estate, right? So these are things that we're looking at. FX stability is improving, so the cost of foreign materials are affordable-ish, but more importantly, you can plan for them. So the problem for a lot of these companies wasn't that things were either cheap or expensive. It was that it was volatile, so they couldn't plan, right? So now it's a lot more stable, so they can plan for these things. So some of the headwinds that you have to look at is high construction costs. As real estate professionals, I'm sure you are aware of that. Limited financing options. Getting a loan from a bank is tough. Extended holding period, 7 to 10 years, needed for full appreciation. Like I said, if you're doing for land appreciation, you need to hold it for quite a while. So those are some of the things that really hinder the real estate space. Now, portfolio allocation, right? When should you allocate? If you're looking at long-term wealth building, right? Definitely. If you're looking for an inflation hedge, these are things I already said. Wealth management, right? Wealth preservation, rather. High net worth individuals with capital for a down payment, right? So 10 to 20% of your portfolio, direct ownership in growth corridors. Where are the growth corridors? Ikoyi, VI, Lekki, Abuja, Asokoro, central areas, right? As much as I feel a lot about Ekpe, that's cool. But if you are looking for wealth preservation, it's not Ekpe. It's not Ekpe. So, some of you might not agree with me. But if you're looking for wealth preservation, it's not investing in Ekpe. Capital appreciation, of course. Income generation, possibly, if maybe you can get a farm there. But if you're looking for wealth preservation, right now, with the way Ekpe is, that is not a place I would go, right? I would go to the places that already are available. Ikoyi, VI, Lekki. Right now, you don't have the money to buy in Ikoyi or VI. You can buy real estate investment trusts, right? There is a company listed on the NGS called UPDC right? They have a portfolio of real estate properties. Some are residential, some are retail and official, and they get rental income. They also get income from selling, buildings and properties, and they pay that as dividends to the holders of the rights. So those are things that you could look into, and those are a lot more liquid than actual land and houses, really. Personally, if liquidity is a constraint for you, maybe don't buy land. Maybe invest in a real estate investment trust. Maybe advise your clients to do the same, right? If liquidity is a constraint for them, instead of saying, no, we'll get a seller for you, right? suggest the real estate investment trust, right? The goal is to gain their trust so that maybe later on they will not actually buy land and property from you, right? So better diversification and quarterly dividend. Like I said, they pay dividends, so income generation. All right, so real estate capital flow, Lagos port extension, or production momentum. Remember, if we're producing more oil and we're exporting more oil, then the port is going to be very important, right? Offshore supply hubs, logistics, logistic hubs and all, those are high traffic areas. If you have high traffic areas, the value of those areas are going to go up. Infrastructure, commercial logistics, diaspora capital, and the note. And I think finally, last asset class, I'm going to talk about mutual funds. Now, mutual funds, landscape for mutual funds, you could have equity mutual funds, fixed income, balance funds, money market funds, a lot. So if you really don't know anything and you haven't been paying attention so far, or everything I'm saying has been too confusing, and you want to invest today, mutual funds, right? You want to go invest in equity markets, you don't know anything about equities, invest in an equity mutual fund, right? You don't know anything about fixed income, invest in a fixed income mutual fund. Now, the drawback to that is this: you are relying on the expertise of the company, right? So if the expertise hires analysts that don't know anything and they lose your money and they don't make any money, then that's not optimal outcome. But if the company hires analysts that know what's up, they have frameworks that they're using and they make a lot of money, then you make a lot of money, right? So that's the thing. You are at the mercy of the fund managers, right? So a lot of them are the fee structures: 1.5 to 2.5% per annum management fee and 0.5 to 1% performance fee, if they have performance fee. Sometimes they only have one fee, right? And like I said, the risk: manager skill variation. You are dependent on the manager's skills, right? There's a fee, right? 1.5 to 2.5% per annum. It can add up very quickly. So there's a fee drag, and there's limited transparency in the unit trust. So especially for open-ended funds where they can just keep on creating units, that can be very annoying. So there's that. And so for the policies and allocation strategy, now the SEC is strengthening fund governance. Some of you may have heard of the circular they passed recently that increased the limits of fund managers, right? So some fund managers now for tier 1 need to have like at least 2 billion, or some even as high as 5 billion, right? Which is good. It means all the smaller players that are more vulnerable to economic shocks, they get taken out of the market, and then you are consolidated into like the big guys that really have a lot of money and ideally the expertise to manage these funds. So the SEC is doing everyone a good favor, unless you're a small fund, then sorry for you. But yes, SEC is strengthening fund governance. Regulators are pushing segregated versus commingled structures, and tax treatment is improving for long-term holders, right? So now passive exposure, if you want passive exposure to, or a more passive exposure, we said about passive, a more passive exposure to diversified baskets of instruments, then this is great for you. They are professionally managed on equity or balance leaves and ideal for smaller investors. So you don't have a lot of money, you have 200k, 300k, you can put it, you don't want to pick stocks because you don't really know much about stocks, you can put it in mutual funds, right? Especially if you were expecting the market to grow from 15 to 30% this year. That could be easy money for you, right? So 10 to 30% of your portfolio allocation for balance funds, and maybe a little bit higher for capital appreciation, right? People who are going into wealth preservation, they don't ideally go into mutual funds, to be honest. But yeah, so prioritize segregated funds with proven track records, low fee funds, and strong fund manager pedigree, right? So there is a list I prepared for someone recently. I don't really want to mention names because I don't want to endorse any other company, but there are some companies that do pretty well, pretty good funds. Another option is a structured product. So a structured product is like an investment asset that gives you a specific return over a period, right? So that's what my firm does. We do a lot of structured products, right? So you can come in and say, hey, I have 50 million I want to invest, and we'll tell you, okay, we can do, there's a structured product that we have, and for 50 million for 6 months, we can give you maybe like 20% or 21%, and be like, okay, if you get that, your basically everything is guaranteed. Your return is guaranteed. You are going to get 20%, and in 6 months you will get your money back. Then we'll ask you, would you like to roll over? We'd like to do another 6 months, another 20% for another 6 months, right? And then you can say, okay, yes, I want to, or no, I don't want to, I want to take my funds, and that's it. So you can also do structured products. Structured products is also a great way for wealth preservation. So if you have a lot of money, 50%, inflation is at 15%. If we give you 20%, you are beating inflation. So structured products are another thing. I do have a podcast that I'm on where we talk about these financial issues as they happen. It's called The Market Lens. And so you can just check it out. I think this is pretty much it for me right now. So please just keep things in mind. Remember what we said, right? Number one most important thing, active versus passive. Passive is a skill. It's the level of passivity, right? So do not choose assets randomly. The asset you choose should be either one that is income generating, capital appreciation, or wealth preservation. And that should go in line with your risk tolerance. And that should be what allows you to choose assets. Now look at narratives, right? Look at the market through narratives. What are the macroeconomic narratives that are going to happen in the market this year, right? And of course, I'm going to disseminate this so you can read through it and understand it. And then so you can know what to look out for and what to invest in, even in both equities, fixed income, real estate, mutual funds, and CPs and all. Okay, I think I have a question here. It says, as someone generally new to investments and also with low funds, what's the best investment option advice? Okay, I'm going to say something that is a bit controversial. If your investable income, right, when I say investable income, the amount you have to invest is below a certain level, let's make that threshold 100 to 200K. Don't invest. It's like, why is he saying we should not invest? Don't invest. There's something called debt alpha. And debt alpha is essentially alpha in finance. Alpha is anything that gets you a return higher than the market, right? So what is the best tool to generate a return higher than the market? It's your own skills. Your skills. Because think about it. I cannot in good conscience tell you invest in stocks because you don't know much about investments. If I should tell you, okay, invest in a treasury bill that gives you 20% per year, what's 20% of 100K? 20K. Okay, what's that going to do for you? Nothing, really, right? 20K. If you take Uber from Sango Tedo to Lekki, if you get stuck in traffic, that 20K can go. That's the truth. But if you take that 20K or that 100K and use it to take a course, maybe a real estate, because this is a real estate forum, a course on how to sell real estate, and you become better at sales, and then you can sell some landed properties and you can start getting commissions. All of a sudden, it's no longer 100K you have. It could be 500, it could be 400, it could be 600, right? I know that people like to rush into investing, and investment professionals will tell you, oh, start small, even if it's 10K. 10K doesn't do anything for you. In practice, 10K doesn't do anything for you. It's better to spend. I tell people, if the only money you have is 10K, have you eaten today? No. Use that money to go and eat. When you eat, you can balance and you can think clearly on how to now move forward, right? So that is one thing, right? So first question to ask is, how low is low funds? That's the first question. If low funds are below 100K, use it to pay for a skill that you can learn, or add it to your emergency funds, right? So you know what emergency funds are? Funds that you're not investing, but you're keeping it in case anything happens. You're crossing the road, Okada jams you, they take you to the hospital, you need to pay. Those are emergency funds, right? So if you have 100K, put it in your emergency fund, right? And that kind of thing. So that is what I would advise. Now, if you are talking about maybe 300, 400, 500K, then I would say put in a mutual fund, right? Select a mutual fund that you trust, right? There are a lot of guys that do that. You have to look at their 4 to 5 year return to tell you if their fund managers are actually good, right? So if they're able to beat the market for 4 or 5 years, they're fantastic. Invest in them. If they don't beat the market, but beating the market is, if like last year, the market did 51.19%. So by beating the market, you need to have gotten more than 51.19%. That's what it means to beat the market, right? So if they beat the market 5 years in a row, invest in them. In fact, tell me, I'll invest in them myself, right? If they don't beat the market, but they still give sensible returns, maybe 60% of the market, at least 5 years in a row, then that's still good. Or you could go into maybe a fixed income fund. But personally, if I have 500K, I wouldn't go into fixed income. I would go into an equity fund. That's personally, not financial advice, right? That's what I would do. If you now have 1 million a hand, you can now call Bestate and be like, I have 1 million. What land do you have, right? Or you can now start going into fixed income, right? 20% of 1 million is 200K. It's not life-changing money, but it's something, right? Then you can now start seeing fixed income. So personally, I would only go into fixed income if I have like 1 million or very close to 1 million. Because that's when I know that whatever I get from fixed income is sensible enough that when I'm compounding, it's not like I have to now wait 10 years for the compounding to now reach something that's even sensible. No, right? So things like that. All right, next question, please. Can you mention examples of structured products, etc., and where to invest funds and such? So structured products, it really depends on the companies that you are going to. So the companies themselves will structure it. So a structured product is it's like an asset that is built on top of other asset classes, right? So it's like I can build a structured product around lending. So let's say on the back end, I lend money, which is actually what a lot of your popular lenders do. They come to asset management firms like us and they tell us, oh, please come give us all your billions, give us all your money, right? We'll give you at this rate. We'll create a structured product. So essentially, we're going to tell you, okay, if you give us 1 billion, we'll give you maybe 1 billion, we'll give you 28% per year, right? And so they take that 1 billion and they lend it out to people, right? And when they lend it out to people, you guys pay back with your interest and everything. They give us our 28% and they pocket the rest. That's a structured product. It's a product that is built on top of another product. Now, usually as an investor, you're not really privy to all the underlying brouhaha of the structured product, which is why you have to now go for a firm that has a good reputation, right? That has a rating that is positively rated, right? So there are rating agencies, right? Augustus and Co, Data Pro, Data Pro, I think Data Pro Max in Nigeria, that they rate companies, right? So they need to have an audited financial statement and a good rating before you now go and give them your money for a structured product. An example is the firm that I work with, Mainstreet Capital, right? We have all these things and, we have really good structured products, but it doesn't just have to be us. Other firms too do structured products, right? I'm not going to plug in my competitors, but other firms do structured products as well. So they have different names, right? It's not as if there is a specific type of structured product, technically a CP is also a structured product. A certificate of deposit, which we didn't really cover, but is given out by banks, is also a structured product. Where can we go to access these asset class investment options? Equities, FGN bonds, commercial papers, treasury bills. For equities, you go to the NGX, right? So now the NGX is an exchange. You go through a broker. So I'm just going to list off some brokers that you could go with. You could go with Meristem. They have a Meritrade platform. It's pretty good. We've used them here. They're pretty okay. Meritrade. You can go with Atlas Portfolios, but they don't have a mobile app. Atlas, that's the problem. You can go with Categorizing. I heard Categorizing has a stock trading platform. You can go with Cardinal Stone. Cardinal Stone 2 is a really good platform, and they have a mobile app as well that you could use. I think Halo Asset Management also has a platform that you could use. Invest Nigeria also has a mobile app that you could use. I think Bamboo is very popular, right? Bamboo, using Invest Bamboo is a pretty decent platform, with a mobile app that you can use to buy equities. FGN Bonds are a little bit tricky. There's a company called iInvest. There's an app called iInvest by a company called Parthian. I'm friends with their former head of research there. It's a fantastic company, fantastic product. You can use that to buy, equities and bonds. I think some of these other apps like Carrywise as well, that also I think they offer bonds as well. Atlas Portfolios offers bonds. I know that for a fact. I use that. Meritrade by Meristem also offers bonds. You can buy bonds on the platform. So like that. Commercial papers are a bit more tricky. So for commercial papers, you are going to have to go to an asset management firm to buy a commercial paper. So like we, Mainstreet Capital, we also help our clients, acquire, commercial papers, but other asset management firms that, in the market, I'm not going to mention them, they're competitors. But yeah, other asset management firms that are in the market, you can also go to them for commercial papers. Same thing with Treasury bills, right? You can get Treasury bills on the apps that I listed for FGN Bonds, especially iInvest. You can get Treasury bills on iInvest. I know for a fact. I have never tried to buy Treasury bills on any of the other apps I mentioned. That's largely because I work with an institution, so we have bankers that we call when we want to buy Treasury bills. So I call the trading desk at Sterling or Fidelity or some of these banks and just tell them, look, this is what I want. So I don't really do like the retail, but yeah, I think you can get on iInvest, or you can approach firms like capital firms like Mainstreet Capital, or even banks as well. I think you can also approach banks as well to ask them to buy. I know for corporate bonds, you can also get some corporate bonds on PiggyVest. How can we use the T-bill bonds and government policy to pitch foreign investors?
I think he meant real estate into the real time.
Oh, okay. In real estate. Okay. I love that. Very practical. Let's get in. Now, the best way to pitch foreign investors is this. First things first, what country are they from? What are the rates for fixed income securities in that country? If they are from a developed country, I can tell you without a doubt, our T-bill rates are higher. Point blank. They're from China, our T-bill rates are still higher. China right now is dealing with a lot of stuff, right? Property crisis, weak local production, weak local demand for their manufacturing. Their PMI is below 50. Even agencies like the International Energy Agency, they lowered China's oil consumption demand. Their oil demand levels, this year because of weak local demand. And with Trump beginning to spit out tariffs again, although he backtracked already. But there are a lot of things happening in China, right now. So Chinese bonds, maybe not so much, right? You can get superior yields in Nigeria here in fixed income, and that's just truth, right? For a lot of these developed companies, you can get higher yields, in the markets. Now, I know that the Chinese government is preparing large stimulus packages. They've even started large stimulus packages. That's possible devaluation of their currency, right? So if you have a Chinese investor that wants to make money, the fact that if they don't want to invest in China, I'm sure they have seen what's going on in China right now, right? One thing they can do is convert their Chinese now. They may or may not want to convert their Chinese currency to dollars, because right now dollars, the trust in the dollar right now in the market is not so great. You can talk to them about Naira, right? Let them come to Nigeria. The RMB to Naira conversion rate is not as Naira to dollar, right? So they can, and because of we have some trade, relations and favorable geopolitical relations with China, you can convert directly from RMB to Naira. So let them do that, right? And then come to the fixed income space. Right now, 1-year bills in Nigeria are going for 18%, right? And it's possible that they can even climb a little higher to 19%, possibly, as the government tries to borrow more money, right? So tell them about that, right? Let them come to T-bills. And since it's 1-year T-bills, tell them at the end of 1 year, if you want to leave and get your funds, T-bills are highly liquid. You can sell anytime and they can move, right? The FX landscape right now is a lot more stable than it was 2 years ago, right? So there isn't so much of a risk of currency devaluations, right? So that's what's going on with government policy right now, right? We're keeping FX, foreign exchange landscape steady to invite more portfolio and direct investments. This is something that is going on generally, whether or not Chinese investors are interested. This is something that's already going on, right? And so you can tell them about that, right? If they prefer a more established currency, even like the US dollar, even though the dollar is a bit fluctuating right now, pitch them on Euro bonds. We have a domestic dollar bond, which was 8% yield? Let them show me which dollar, which US dollar government security is up to 8%. The highest you see is the US 30-year, which is like 4.8% right now. You're not gonna get up to 5% anywhere in the US. A government security in the US, you're not gonna get that. So if they would prefer to keep their money in US dollar because it's too easy to for them to track, let them come and invest in US dollar domestic bonds. Get a nice 8%. That's double of what they'll get in the US, right? Or almost double of what they'll get in the US. Now, how can that be applied in real estate in real time? Okay, what are some government policies right now that is going on? One, we're building a lot more refineries, right? I had a list of refineries that are being built. There is, I think they just launched like a gold refinery plant in Lagos, and there's a lithium plant in Nasarawa that they also want to launch. You see a lot more policies that are aimed towards industries, especially in the Lekki Free Trade Zone. Something that's still going on, by the way, right? Tax free. A lot of companies there in Lekki Free Trade Zone are a lot more liberal with using the dollars to just investing directly in dollars and even paying their staff and stuff in dollars. And there are a lot of tax benefits for that. So they want to invest in real estate, bring them to the Lekki Free Trade Zone. Tell them about all the political incentives that they have, all the economic incentives that they have, the tax breaks that they have, to set up industries there. Even if they don't set up industries there, they can buy a lot of land and lease those lands to industries, right? So where are guys like me and Baker, guys like Nymeth, the pharmaceutical guys that want to build new factories? They're going to need land to do that. Now, you might have to do a little bit more research to try to find out where they are looking towards and get your real estate guys to buy land around that area. If you have a factory going up, you're a real estate professional, what happens when, a place, value of land, when a place is developed? It goes up. So those are things you want.